Hey guys, Doug the Retirement Guy here. We got a great video for you. It's the YieldMax Covered Call ETF, 31 different funds. We're going to review the performance of how did they do, where are they sitting at, and give you kind of a rating score of if it's one of these things to even take a look at. Before we get into that, I want to say thank you to each and every one of you who have subscribed and have supported the channel through Patreon. We want to thank each and every one of you because this channel just continues to grow. And if you're not part of it, hit that subscribe button. We'd love to have you. If you can support the channel, look down in the description, hit that support button to the Patreon and join there. Let's get into today's video. We have a lot to cover. Notice to all viewers, past performance does not guarantee future results. The information provided in this video is for educational, informational purposes only. It should not be considered as financial information or as investment advice. The examples or suggestions discussed are illustrative and may not be suitable for all individuals in your individual situation. Always consult a licensed financial advisor or a professional before making any financial decisions. The goal of the funds is to pay monthly income on mostly covered call premiums. The funds did not invest directly into the selected stock. The fund's strategy will cap its potential gains if the shares increase in value. Many of the funds use a return on capital to save on taxes. The first fund we're going to cover here is going to be the TSLY, which is the Tesla Option Income Strategy. Now, of course, as you can tell, most of them will tell you in the title that this one is dealing directly with Tesla. Now, again, they are not investing directly into Tesla. They're doing it in a covered call option in a different way. They pay a solid dividend across the board. You will see over 12 months, they've paid $9.96. They have an average of 77 cents per month, and their cumulative is 129.12% over the 12 months. Now, this is one area I want to start off with right off the bat. The percentage off of it sounds great, but you've got to look at what did you lose in NAV? What did the value of the stock go down or up to have a complete combination? It would be a fool's game to take and put all your money on the table for this Tesla, and I'll show you in the next slide why, just because it says 129%. But that is a very, very strong number. Let's take a look at the overall over the past 12 months. The fund came out on 11 of 2022. So the performance over the past 5 days, it's up 1.31%. 1 month, it's down 5.75. Year to date, it's down 44.69. And for 1 year, it is down 53.41%. When we start looking at this, the average is $8.34 in 30 days, $8.43 in 90 days, and $11.84 in 365 days. The current price is $7.71. So when we put this all together, you will see when you originally a year ago bought into this, it would have been $16.55. The current price of $7.71, the dividends collecting $996, your stock value would have went down $8.84. The total return, once you add in your dividends, you would have made $1.12 or 6.77% on your investment. So this is what I'm telling you. You're making 129% in dividends, but you have to pay back most of your dividends to try to get yourself to the margin in a positive number. So this fund is only making $6.77%. So we give that a C grade. And the reason why I say that is you got to use the barrier. Fidelity right now has a money market fund that's paying 4%. So I could take all my cash and put it into a Fidelity account, which is a set it, forget it, never worry about it at 4%. We have a big gamble here, and we're only going to pick up 2.77%. That's why it gets a grade of a C. So you really got to do this as the barrier is getting above 4. Anything below that is failing. Anything above that is going to get graded accordingly. Now this fund you can see here is well below the 30-day averages. So this is why I'm watching this and saying 5 days, it's up 1.31%. This is one I'd be seriously watching, that it may be time to be buying at this low $7.71 rate if it continues to slowly start to climb. This is why you keep this on your watch list to see which direction it's actually starting to head. Our next one is going to be OARK. Now this one invests into the ARKK. The dividend of this one is, again, you'll see, is routing right around, bouncing up between that 50-cent and 25-cent range. The 12 months of $4.47 payout, an average of 37 cents per month per share, and over 12 months, this has had a 51.11% return. When we look into the financials of it, again, this came out in January of 2024. The 5-day performance is down 1.8%, but in 1 month, it's up 871. Year to date, down 1431 and down 20.62%. We look at the 30-day average of 845, 90-day of 799. So you can see the stock is coming up in value over the past 60 days. And overall, 365 days, it's 954. The current price of $8.74 is definitely well above the 30-day average and well above the 90-day average, getting closer to that 365. When we look at the total package of it, though, the buy-in was $11.01 originally, the current price of $8.74. Add in the $4.47 dividends. Your stock value is actually down $2.27. Your total return, though, once you include the dividends, is $2.20, or a 19.98% growth margin. So this one, actually, we give it a B+. Now you'll question, why do we go B+? Because you're at 19.98, but you're losing some stock value while you're doing this. So you take some dividends away from it. But this is definitely well above that 4% that we've always looked at. So this one here, you have to, again, put it on a watch list, see where this stock is going, or where this fund is going to go. 874, if it continues climbing higher, we could get to that 954 rate, and that'd be a nice gain. But the 5-day says it dropped 2%. This is why I would put it on a radar, watch where it's going, and give it just a little bit of time to evaluate where you see this one flying. Our next one is going to be APLY, which is going to be the Apple stock option, and they do a fairly decent job of steady dividends coming across. They've paid $4.43 in 12 months, 37-cent average, and they have a 34% dividend return rate in 12 months. When we look at the financials of this one, we will see that in the past 5 days, it's been up 1.01%. 1 month, it's up 1.8%. So those are some good, solid foundations that we're seeing that the stock is slowly making a climb back to where we would love to have the number to be. When we look at the year to date, it's down 27.83%, down 1 year, down 30.37%. Again, the 30-day and the 90 days, 12.81 and 13.61, with the 365 at 16.616. The current price of $13.02, it's definitely past that 30-day mark, so it tells us it's on a growth, and you can see that in the performance, and you can see that against the average, getting closer to that 90-day mark right now. Let's throw this into the final piece, though. The buy-in originally at $18.86 with a current price of $13.02, your dividend of $4.43, your stock value is down $5.84. So that means your total return is negative 1.41, and their margin is down 7.48%. This is where I show you that it would have been better to take your money and put it all into a Fidelity 4% account, and you'd be smiling right now. We give this a grade E, but I continue to tell you this should be on your watch list, because look at the numbers right now. In the track history, if this thing continues to climb, you will have to get basically $1.41 to break even. So I think it has to get up to the $14.43 price, adding in your dividends. But if you're buying now, how would this affect getting $4.43 per share if you're buying at $13.02? So it's kind of one of these things is, yes, we have great NAV erosion, but the things have leveled off so well with the monthlies that it may be time to really look into possibly buying into at these lower numbers. Now we get into the NVDY in NVIDIA. Now this dividend has bounced up a little bit. They've gone dramatically up to that $2 and almost 50-cent range, and all the way down to 67 cents. So it's a very volatile stock, and they love that in these covered calls. They've paid $13.01 over the 12 months. They have an average of $1.08, or a total of 74.96% return. Very, very strong dividend. If the growth rate holds, we're going to be doing very, very well here. Now, this one came out in May of 2023, and we see the performance having great growth in the 5-day and having great growth in the 1 month. As you can see, 1 month they're up 6.37%. The year to date and the 1 year both are in the negative factors, with that 1 year being down 40%. When we start looking at the 30, 90, and 365-day averages, you can see over the past 30 days, the average is actually starting to climb, which is a great sense with the big performance that we're starting to see. Current price of 17.36 is taking it well above that 30-day average and well above the 90-day average. And again, we're getting closer to that 365 average. When we put this into the total package, how does it look? And here we go again. We go a 6.19 total percent margin. So that $13.01 dividend return is covering the stock value loss. So this goes right back to what we're saying is that is it time to buy? These will always be put on the watch list to get some value where the stock is heading. I believe this one is heading north and it is time to jump on and buy, but we will still give this one a grade of a C based on the risk. Now we get into the Amazon AMZY, the Amazon option income strategy. And we look at the dividend. Dividend's doing, it's peaking, coming down, and start to settle into where it should be. The 12-month, $7.76 payout, 65 cents average per month, and they're paying out a 48.10% nice dividend across the board. If the question now again comes into is, are we going to get the performance out of it? And over the past, basically 5 days, it's 1.25% increase. 1 month, it's 0.12. Year to date, down 14%, and 1 year, it's down 27%. So it has a lot of room to make up for it. When we look at the 30, 60, and 365, again, we start to see an increase in that 30-day average starting to grow. The current price of $16.14 is not much above that 30-day average. It's definitely well above the 90-day, and it's got about $2 to go to that 365. When we look at the combinations, again, things are starting to look in a positive way. 11.27% margin off of this fund. You have a $5.34 makeup, lost the stock value, with a total return of $2.42. So this is a fund, I always add it to your watch list first, but this is a fund that shows that we're having some starting to get some positive growth in a positive area, and we have room to grow up to that 365-day average of about $2. This one we will give it a grade B because of that big 11% total gain already from the original buy-in. We get into the Meta options income, FBY. Their dividends have already flattened out, pretty much paying a fairly decent price across the board. They have a $7.27 12-month with a 61-cent average. They've paid a 43.23% dividend for the first 12 months. When we look into this one now, you will see the performance. It's positive 3% in 5 days, positive 6.37 in 1 month. It is still down for the year to date, down 25%, and down 1 year is down 40%. But look at the days again with the 30, 60, or the 30 and the 90-day averages. The 30-day average is higher because the stock is starting to grow. It's starting to gain. 16.81 cost for the fund. It's already well past the 90-day. It's past the 60-day. Just very similar to the Amazon, it's got about a $2 run to get to the 365 average. When we take a look at this one, the original buy-in to the current cost and the $7.20 dividend, the stock value is only down $1.55. So that gives them a total return of $5.72. So if you bought this a year ago, you would have a margin of 31% growth. We give this a solid A because the thing is already recovered to where you're making some very, very good percentages of 31% total return. For someone who's not into it right now, I believe this one better be high on your watch list because I believe this one's already starting to take off. The train is leaving the station with that 6% growth in the past 1 month. Now let's go to GOOY, which is the Google option income strategy. And again, we'll see this as the dividends have been fairly steady and fairly regular, right around that 35 to 40 cent range. They've paid $4.88 for 12 months. Average is 41 cents. They have a 40.39% return on dividend. Very strong here. Now let's take a look at the Google GOOY option income. And you can see the chart just shows pretty much almost a red flat line. Not a lot happening. I don't see a lot of growth out of it. When we take a look at the performance, it almost proves again that we are pretty much right. It's down 1.23% for 5 days. It's down 1.48 or 4.88 for 1 month, and 18% down year to date and 33% down 1 year. When we turn around and look at the averages, you will see to the current price, the 30-day is slowly dropping off. The 90-day is in the same track, and the 365 average is just a little bit above that. It shows again that what we have seen on the chart, that we are exactly right. This thing has stalled. It's going nowhere. And even though that the $12 is below the averages, if we would see some performance to start show us that this thing wants to go north, it wants to go, it may be a time to buy. But until I see some areas that this thing is starting to take off and move, it's going nowhere. And that's why we look down below, we'll see we've lost $5.80 in stock value from the buy-in. Even when adding in the dividend, we're still down 92 cents a share, or down 5.15%. So this one really gets a grade of an E because we're losing money. We would rather put our money in the 4% fixed income. CONY, this is the coin option income. These have really been dominating in a lot of markets. And we kind of see that they've paid a fairly strong dividend at 53 cents this past one. They have paid $11.36 over the past 12 months. They pay an average of 95 cents, and they are at 115.69%. Again, if this number holds, this is a very strong buy. But as we've seen, most of the funds, the dollar mark is not holding, the stock value is not holding, and we look at the chart here, and we see fairly similar type situation. Now, the performance over 5 days is up 6.05%. Over 1 month, it's up 21.99%. Year to date, down 24, and 1 year, down 48. So as we just looked at the stuff from Google, we got a good comparison here between these two. This current value is $9.82, well above the 30-day average, well above the 90-day average. And we have a positive performance over 30 days that this stock is starting to climb. So is this a fund that is probably at its bottom and heading up? Everything on the board shows that it is. This is how you can read stuff. 1 month it's starting to grow. 5 days it's continued. This is something, again, I wouldn't be afraid to say maybe this is where we'll put some money into. When we look at the bigger picture, it was up to $20.03, which is the same as the 365 average. And it came into $11.36 per share. So that big share price does a lot for picking up stock value. If the stock fund can continue at $11 and you're paying a $9 price point, you could get some big returns that the previous screen showed. Right now it shows $5.74 and we give it a C-. And the reason for that is we have big stock value loss. Does that mean future performance? No. That means the possibility that things are turning around and time to get on board with their coin. NFLY, YieldMax, the Netflix option income. Netflix has normally done very well in past performances. You can see their dividends. They've paid really high and they've come down really low. So it is a fund that you have to really count on your daily average. They've paid $8.22 over the past 12 months. 69 cents is their average. The last performance was 43 cents. So it's a little bit down from the last, but the one previous that was right on track. 45% dividend return so far. And we look at the chart and we see a lot of green right now. That will tell us that the fund is actually in a positive zone, and it is right. Over 1 year, the thing is up 4.09%. Year to date, it's down 0.88. 1 month, it's down 0.82. In 5 days, it's down 2.9%. So it tells me that this is starting to come back to reality and come back down to a price point. When we look at the 30-day, 90-day averages, you can see in the past 30 days, it's really had a strong run of gaining on its value over the 90 days. And when you look at 90 days over 365, again, says that's flat, that the average goes up but comes back down to give you a flat number. When we look at the current price of 1805, that puts us above the 90 and 365 range. Along with an 1854, we're well below the 30-day average, so it tells me that stock is somewhat on sale. Where will this one go? We don't know, but I believe with looking at the chart, it's holding at the top, even with a little bit of down in 5 days and down in 1 month. If that 5 day turns around and changes and sticks right around with that 1 month, it's probably one of the funds that we'll want to be into for long haul. The buy-in on this was $18 or $16.90 and the current price of $18.05. So if someone bought this a year ago, they are smiling. They collected the $8.22 in dividends, and they have paid, or they have a stock return value of $1.15 for a total return of $9.37 or 55.44%. We give this one a grade A because of that great margin over time. Now the DISO, this is the Disney option income. And Disney we've not heard a lot about. And when we look at Disney's numbers, again, just like Netflix, it's up and down all the way around because these two are very comparable to each other. The 12 months, they've had 5.29%, or excuse me, $5.29, an average of 44 cents, or a 37.62% dividend. So we look at the chart originally in the April timeframe, it dropped, it slowly recovered back up and plateaued. And we see the performance down 1.92, 1 month down 2.21, year to date down 16, and 1 year down 18. So definitely a lot more respectable of only being down 18, but it has not recovered in the past month any higher. When we look at the 30-day, 60-day, or 30-day, 90-day, and 365 averages, you can see they're all about within the same range. 1404 is below the 30-day average. It is above the 90-day average. So this is a stock that's starting to just basically, as I said, find its plateau. It's plateaued at 1404. Will it go down? Everything can go down. Will it go up? Very easily. But when we look at this as a long haul, the buy-in at 1549 and the current price of 1404, that $5.29 dividend looks very, very strong. Even with only a $1.45 stock value drop, you're picking up $3.84 or a 24.79% margin, which is primarily all from dividend. So that's a very solid piece, and that's why it got a grade A. Now let's take a look at MSFO, which is the Microsoft income strategy. We look at their dividends again, fairly strong across the board, fairly smooth as well. They have an average of 43 cents or $5.17 paid out over 12 months for a 28.84 total dividend payout. When we look at the income side of it, and let's see what the stock has really done, you can see it hit in the April and it's come up and then flattened out. And we look at our performance chart, as you can see, up 0.5% in 5 days. 1 month, it's up 2.51%. It's down only 1.32% for the year and down 18% for the total year. When we look at you can see the 30-day average is climbing, which is a strong positive telling you that the business is coming back and the stock is growing. It's past that 90-day mark, which means that we have to get that rolling, and over 1 year, it's peaked out. $17.94 is the current price point, so it's above the 30-day program, it's above the 90-day, and you basically have about 29 cents to get to the 365-day average. So when the buy-in originally was $21.54, a $17.94 current stock price, $5.17 in dividend, your stock value is down $3.58 for a total gain of $1.59 or a 7.39% margin. We give this a grade C. That's a lot of risk to just get 3 percentage points over the 4% base that we use. So Microsoft as a whole on this one here does a decent job, but it's nothing that I would really be all over putting a ton of money into. As we know, we can get better performances off of less risk. XOMO, and this is the Exxon Mobil side of it. And with gas prices somewhat stabilizing and wars doing what they're doing, we can see this one coming through. $4.31 total paid over the past 12 months for a 33.67% total dividend on an average of 30 cents. Now, when we look at the income strategy, the bar chart, we see it dropped off in April, but it's pretty much been flat ever since. And when we look at this, we'll see the performance is exactly right. 5 days, 0, 1 month, 0.39. Those are neither one of those two are nothing to really speak about. It's down 12% from year to date and down 22% for the year. So when we look at the current price of $12.80, we see that's probably about the 1 month gain onto it, and over the 30-day average, it's just a hair above that. To get to the 90-day average, we're only talking a 40-cent gain. This is where the buy-in originally was $17.04. The current price of $12.80 gives us a negative of $4.24. A dividend of $4.31 would only net us a total of 7 cents per share across the board for a 0.41%. We give this a grade E. Again, we would put the money into a 4% package and be done with it. Even if this one was flat and you stayed at this price, the dividend of $4.31 per share is still nothing to write home about. It's nothing spectacular. I would definitely would not add this one to my watch list. I would just kind of ignore it and let it go. JPMO, the JP Morgan dividend package, paying $4.83 over 12 months, 40-cent average, 28% dividend. We look at the bar chart. 1 day, it's down 1.91%. It's up 2.98 over a month, still down 14% for the year. This one is just a hair above the 30-day average, and it's actually above the 90-day average. That's because this one had a nice little spike over the past 30 days to get it to that 2.9% gain. When we look at the total with the dividend and the stock net value of losing $2.78, it gained $2.05 total for a 10.41% total margin. This one got a grade B. And the reason for we have this at a grade B is we're starting to see a little bit of growth, but then a nice setback. So it's really setting right now in the averages, but a nice $4.87 or 83-cent return. If the stock value stays where it's at, it could be a long-term run. Put that on a hold. AMDY, the YieldMax AMD option income strategy. And this one goes into the advanced micro devices, which is AMD. If you're not familiar with that, you can see the dividends over this year so far has been very flat. They pay a $5.87 return. They have an average of 49 cents per month, and they've paid 70% dividend for the past 12 months. We look at the bar chart right off the bat, you can see it. It's kind of had a slow, very slow coming out of that April point, just a slow, steady gain. It's not back to positives. It has not recovered 100% from the April tariff situation. But what we are seeing is in the past 5 days, a solid 6.55% growth. 1 month, solid 6.27. Still down 53% for the whole year. And then we take a look at the current price is blown away the 30-day and the 90-day average at $8.30, closing in on that $10.55 average. So it's got about $2 worth of room to grow and gain if it can continue doing what it's doing. Even with all that, AMDY was a $17.75 buy-in originally at $8.30. We have lost $9.45 of our value of our stock. Even paying the $5.87 in dividend, we are still down $3.58 or down 20% total. So this one, again, was going to give us a grade E. The only positive I have to it is that you're seeing some nice growth coming in the past 30 days. Where this one will go, I don't know. AMD has not been as real strong of a growth factor that we would like to see, and I don't see it long term. I would put it on a watch list and probably set a price point to buy in at, but I would really be careful about the value of the stock. PYPY, which is going to be our PayPal option from them, and that is going to give you another flat, nice running dividend, $7.52, 61% dividend return, 63 cents on average. And you can see this one has done the same exact thing. It's down 5% in 5 days, down 7% in 1 month, down 31 in year to date, which tells me that this stock is just, this whole year has been a terrible year for PayPal. And the current price of $12.20 means you're down below that 30-day average. Now, what's crazy on this one is a buy-in was originally $16.22, is now $12.20, but it's that big dividend of $7.52. Losing $4 in stock value, we've gained $3.50 in dividends for a 21.58% margin. This one gets a grade B for that 21%. Even with everything being red, I would put this on the watch list and see if this thing continues to drop, how low is it going to go before we can buy in? If we see a turnaround over the next 30 days, this may be a stock to say, hey, let's jump into it. Big positive, $7.52 in dividends on a fair price. It could be a player. XYZY, and this is the block. Block Incorporated. Again, this one's paying a very decent dividend across the board, $9.14 or a 98.01 dividend. Block has been flat. Coming out of the March Madness has pretty much been flat across the board. And when we look at this again, is down 5, down 3, year to date's down 48, and 1 year it's down 51. When we take a look at the 30-day, 90-day averages, we're about right where we expect, and the current price is $9.33. This one, I will say again, that we're going to put this on a watch list. This could be another package of PayPal. If we find the bottom of this, it may be time to jump in because that dividend is so strong. The original buy-in was $20.22. The current price is $9.33, but that dividend of $9.14 makes up for a huge adjustment that we can play on. Even though the stock value is down $10.89, we're still total return is only down 1.75 or 8.65% margin-wise. And this is why I'm saying at $9 and getting $9 in dividends is it's a game player, but you got to know when it hits that bottom before it starts growing. Because if it continues to drop, this could be down to a ULTY pricing where it gets down to a $6 value. We give this a grade E. So MRNY, the YieldMax, and this is the Moderna. Dividends, very flat, $3.32, positive 121.59% dividend return. As the price goes through, the stock is completely flat. But look at the performance over the past 5 days and the past 1 month. We're seeing on the past 5 days up 9.64%, 1 month up 8.33%, year to date it's down 48, and 1 year it's down 81%. Now, why is the dividend so high? And this is where it throws people off, because the price of the current stock is only $2.73. Now, when we turn around with this one, the buy-in originally was $15.41, the current price of $2.73, and you're gaining $3.32 a dividend. That's where you can get 129%. Crazy numbers, but the math is what it shows. We've lost $12.68 in stock value, which means our total return is down $9.36, or a 60% margin drop. So very similar to what you're seeing on the performance side of it. The positive side is the stock is $2.73, and in the past 30 days, we've had an 8% growth. So we're looking closer that this thing could run to that 365-day average, which is about a $3 gain. So is this one to play in? It's your choice on what you do, but I believe this is a package. If the dividends stay where it's at, it's probably a worth game to play. We do give it a grade E because we've lost money onto it, but current new buyers may have some value to it. AIYY is the AI option. This gets into the C3.ai incorporated side of it. They pay a $5.28 12-month dividend payout. And again, we're at 121%. I hope you're learning this, that the dividend yield, that percentage, only represents what we're getting from a stock price compared into what we've paid into. You have to make sure everything equals out completely before just saying, I'm collecting a stock that pays 120%. And this one here, in the past 5 days, we see it's up 2.3%, down in the past 30 days, 1.58. So it's starting to find some legs to kind of recover, but the chart shows us that it's not have recovered at all since March. And we look at the price thing of $4.35, which is about par with the 30-day average. So unless this thing starts to get some legs and taking off, there's not a lot of room over the 90-day average for this thing to grow. That's why we look at the negative stock value of $7.71. This is where YieldMax has gotten a bad rap, that they're just NAV erosion. But if they continue to generate dividends, $5.28 in dividends on a $4.35 stock, that has something to talk about. But when we have a total return of $2.43 or a 20% loss, you got to be a gambler. You got to know when to buy, when to get into these things, when to get out of them, and so on. That's why I look at these charts. I look at the performances over 5 day, 1 month, and year to date. Tells you some numbers. You look at the 30-day average, tells you some numbers too. Everything here tells me this thing's flat. That's why it would be on my watch list, and it is on my watch list to see if that 5-day gain continues for 2 weeks. Will it continue for a month before I even think about getting into it? This is a grade E. MSTY. Now, I know a lot of people out there probably have this one because I've heard people talk about it. And this one here has a $27 payout for 12 months and 125% return. So the question I come back and ask everybody, is this going to be another one of those fake 125% dividend returns? We look at the chart up here. It seems it recovered, but it's trying to grow at the end, but is it really taking off? 5 days, 6.88%, 1 month, 3.86%, tells me, yep, it's starting to get some legs. It's down 16% year to date. 1 year, it's down 12%. When we look at the current price of $22.07, it's wiped out the 30 and 90-day average. It's above that. So the only thing we can look at is, can we get to the 365? And that's a $3 gain. $3 gain, that would basically put us at about a 15% growth that we would have to get. Can this stock get 15% growth? I don't know. But if it even just stays within that 30 or 90-day range, even so we drop off a little bit, we're gaining $27 in dividends. So it's a very strong number. The buy-in was only $28.05. So to me, this stock has been almost literally flat across the board. Losing $5.98 over 12 months, we still gained $21.61 per share for a 77% margin. Now, this is a stock that I would say, hey, look at, even if we're at the buy-in at 28 or we buy in at 22, that if this thing can hold, like I said, in that 30-day average and the dividend holds, this is a grade A. This is a stock that you'd want to make sure that you have some investment into it. And when I say investment into it, you never put more than 5% of your total portfolio into any part of this. YBT, YieldMax Bitcoin option income strategy. And that is right into Bitcoin. This one shows an $8.60 monthly, or I'm sorry, yearly payout, 79.44%. Bitcoin has been a very volatile piece, and this is what makes the dividends do so well. We look at this as a 5-day 1.88%, 1 month up 8.82%, year to date down 12.45, down 30%. Current price of $10.83 puts it right in that 30 and 90-day averages. And if you can do the 2%, which is basically a 20% gain to get to the 365-day average of $12, it's a questionable piece. It's still $10.83 current price. The dividend pays out $8.60. It's down $5.37 stock value, but still has a $3.23 even with the high end value. So this one here is another one of those. I would probably put this on a watch just to see how the Bitcoin changes. We gave it a grade A because you're getting 19% even from the loss of NAV that we've had. GDXY, the YieldMax gold miners option. This one is, again, playing the game on gold. $6.62 over 12 months, a 44% dividend. Very, very bouncy, very jumpy. This is a very, very rocky road that you're getting a lot of ups, you're getting a lot of downs, and a lot of all over the place. Year to date, it's up 4%, but 1 month it's down 3, and 5 days it's down 1 and down 20% for the year. The $15 is below average. And when you take a look at the $6.62 in dividends that you're gaining, even with your $4.04 lost originally, a $2.58 total return for a 13.55%. We did give this one a grade A because you are below that 30-day average, and hopefully it will stay at this price point and start to gain. So again, put it on your watch list to see where it goes. If it drops further down, which the performance side shows me it is, but you see the chart where it goes up and then back down, up and back down. SNOY, the SNOW option, which is snowflake. Dividend fairly strong, $11.21 over 12 months, 70%. Now we look at the income, you can see that the chart is a little bit bouncy across the board again. And when we look at the performance, we're seeing that 8% down in 5 days, 8%, almost 9% down in 1 month, down 10% year to date, and down 20% for 1 year. Your current price is actually above their averages, so it tells me that there is some room for this thing to continue to drop down. And we look at this, the dividend of $11.21 per share. Taken up for the stock value loss, you're still gaining $7.37 or 37% margin. Watch list, it's a grade A. Watch list, put this on the watch list, because right now, if this thing gets what I expect to do is probably another 10% drop. 10% is going to put it down to about the 14.30 range, and it may be time to invest into this one if it can hold where it finds its finally bottom and pick up that $11 dividend across the board. ABNY, and this is the Airbnb strategy. Now, a lot of people don't know that you can actually be invested into the Airbnb and get the dividends from it. And the dividend history is $6.30 or a 53.77% dividend payout for 12 months. We look at the stock charts, kind of flattened out. It's down only 0.28% for 5 days. It's down 5% over 1 month, 21% down year to date, and down 43% over 1 year. We look at the current price. It's down below that 30-day average. So it's that tells you you're probably getting to a bottom. And when we get to the bottom, what happens? The stock was an $20 stock. Its stock value has dropped $8.54, but you're gaining $6.30 in dividend. So your total loss would be $2.24 or 11% drop. So you know this one's going to get a grade E for that dropping off. But what we say here is what you put this again, watch list. Does it drop anymore? Is it finding its bottom? Which it tells me some of the stuff is starting to tell me it's finding its a natural bottom, and then invest to get the $6.30, which would be a nice dividend. Now BABO, which is Alibaba, paid a $9.23 dividend because of the volatility of Alibaba stock, 64% dividend. We look at that chart. dropping, and the numbers and performance shows accordingly. When we look at the current price of $14.41, we're well below that $30 average, but we're still seeing a drop off. When in just 5 days, 1/4 percentage point drop off, but 1 month down 11. I don't think this one's found its bottom yet. I think there's more room for it to drop. The dividend of $9.23 definitely covers a $6 stock value drop off for a 15.83% dividend. So before I buy into this one, even though it gets a grade B, I would still watch and let this thing settle down a little bit more. I believe there's probably at least another 10% drop in this pricing just from what the charts are showing us and telling us in the history. TSMY, and that is the Taiwan Semiconductor Manufacturing Company. So paying a 45% dividend, $7.31, a lot of money being set there. The stock has come out of the trade wars. It's coming up, but we don't know where it's actually going to sit out at. It's down 3.97% in 5 days, down 3.59% in 1 month. The current price is well below the 30-day average. It's closer to the 90-day average, to be honest with you. So that means this thing has a little bit more room, I believe, to drop off. When we get into this one, a $7.31 dividend, the stock value has only dropped $4.06. So you actually have a positive $3.25 area for a 16% gain. Now, this is where the grade will get you a B+. Reading what I'm seeing in the performance chart that we put up there and doing the 90-day averages, I think there's still some room for this thing to drop before you buy into it. I would add it to the watch list once it got to probably the 90-day average at 15.22. Probably a time to start putting some money into it to collect that $7 dividend. SMCY, and this is the supercomputer. Dividend's been flat on this one, but the positive is, look at the big payout. Pays $1.82 per month for a $21.80 12-month return for a 108% dividend. Now, if we can get the growth out of this one, and again, here's the chart showing us it's been fairly steadily flat with a few little peaks up and down. So where does this sit? 5 days, it's up 5.13%. 1 month, it's up 4.97%. The stock is above the 30-day, which is expected, but getting closer to that 90-day period. If I had a little more information, if I track this one, I did not put this one on my watch list at any time at all. I will put it on my watch list because right now I like that 5-day growth. I like that 1 month growth to get that $20 stock price is probably a fairly decent number to be at, especially when you're below the 90-day average. When you do that, you're getting $21.80 in dividends, which would give you actually a positive. But because this was a $50 stock originally, we've lost $30 in stock value, but we've been able to get our return down to $8.75 for a margin of $17.29. It gets a grade of an E. But does that make it not a buy value? Well, if I don't have any money invested into it, it would be. If I did buy it at $50, I'm right now down 17%, and I'm crying in my soup. Not a good situation to be in. PLTY, and this is the Palantir Technologies. This one has done fairly well. We've watched this one. It's been on our watch list for a little bit. $38 in dividends, 57% dividend return. It has been a positive throughout the year. 5 days up 1.63, 1 month up 5.56, 0.5%. Year to date, it's down 6.42, but for 1 year, it's up 30%. It's at a $66 price point, so it's well above the 30-day and 90-day and 1 year average. Now, when we take a look at this, the buy-in originally was $51.48, $38 dividend made for a huge change. So when you add that $14.68 stock gain, the $53 dividend total return with the dividend included, you've already doubled your money of what you invested in originally. So this one gives RA all across the board. Now, what do you do in this situation? I keep telling you, you have to put this on the watch list to see. Is it time to buy into it? Is there going to be a drop off? Are we going to do anything? It would be hard for me to put the $66 into it when we're so close to that 30-day average. I would probably wait for the next dip and buy into it. MARO, which is the MARO Holdings. This one pays a 50% dividend with a 12.66 payments over the past 12 months. Just a pretty much U-shape all the way around, slowly coming out of its gap. In the past 5 days, it's had a 10% run. 1 month, it's up 5.51. Stock value at $25.09. Problem with this one, we go back to it again. It was a $47 buy-in stock originally. is now that 2509. This is one, if you're into it, I'm sorry to tell you, you're down 19%. If you haven't bought into it, it's time to start taking a serious look at it to say maybe it's time to get some nice dividends of $12.66 per share. So we do give it a grade E. CVNY, and this is the Carvana package. And Carvana's been doing fairly decent. I will put this is where it's asterisk start. We're getting to the end of the line here, that they've only been out for 5 months so far, have a 36% dividend return in 5 months, 15%. This is the problem with Carvana's pricing, though. It is up and down, up and down, up and down. As the used car market does well, then the tariffs kick in, it does better, and then they do worse. They're all over the place. And when we look at it, Carvana's pricing, the CVNY pricing is at $43.11, so it's below the 30-day average, but we're seeing a negative on the other side. Everything is dropping. So I would allow it to drop again, try to get it closer to that 90-day average, and see then before I even invested into it. Anyone who did buy into this originally lost $6.89 in stock value, but because of the $15 payout, it covered that for an $8.95 gain for a 17%. This gets a grade A. Now, performance-wise, is grade A is if you bought into this, you're doing well at 17%. Question is, will it continue doing what it's doing? I always believe I like to buy things on sale. That's why I tell you, put this on the mark. Even if we got to the 365-day average, is where I would be buying in at this in myself personally. But remember, this is all just for educational purposes. This is not financial advice. HOOY, which is the Hood Robinhood option. This one has only been out, guys, 2 months. And right now, $9.81 already in just a short period of 2 months. Their last dividend, it blew it out at $6.05. So it really blew this thing off the record of what we're dealing with. Hood has been running. This has been a runner. And this is the problem with only being out a couple months. What do? 5% gain in 5 days, 16% in 1 month, year to date, 37%. Our 30-day averages, our 49 averages are blown out of the water at 71.62. This one here gets a grade A because of the huge, huge returns and margins across the board. We don't know, and I can't even tell you. We may look back at this and say $71 is a heck of a price to buy. It's a great place to be. I don't know. I give you this information. If you bought HOOY at $52, more power to you. Personally, I bought HOOW, which is a weekly payer, and it's doing strong there as well. And I believe our final stock that we have at this point in time is going to be the Berkshire Hathaway. Oh, let me back that up for you. Sorry about that. Well, let's continue on anyways, because there's not much there to talk about on the dividend side of it. They've only paid one dividend so far, which is 50 cents. The Berkshire Hathaway, I've seen this on Omaha also, that the price has come down and dropped off. It's down 1.32% in 5 days. It's down 1.86% currently. I expected more out of the Berkshire Hathaway packages. They have not really performed as well as we originally thought, but they are on our watch list. I did buy the Omaha, which you can see a video that we have on that one, and that pays a solid 15% dividend, so definitely better than what we're looking at from this one. Guys, I put it up here, Doug's picks. I put all of our A's up there. The best one, PLTY, giving you 102.99%, MSTY at 77, the Netflix at 55, and the HOOY, the Robinhood at 54. I put everything up there for you to view. You can look at this over. It's Doug, the retirement guy. I hope this information was a lot. I know it was a major overload, but this is what's coming from YieldMax. I wanted to give everyone some true answers about seeing things that saying, I got 120% dividend, but are you really getting it when you look at your total return? If you like what we're doing, give us a thumbs up. If you haven't hit the button, hit that subscribe, join the community. And also, best of all, if you have any comments, leave them down below. And remember, all of this information is just for educational purposes only. Ask a financial advisor for any real financial advice. Guys, help the channel grow. If you can hit that subscribe button or you can help support it, we appreciate it.